Hello, everyone, and welcome to our FCI Live 2025 series. This is our final day of the 2-week series, and we're so glad you're here with us. We've had terrific turnout today, and I am so excited about this session. This is Financial Foundations for Startup Food Co-ops with Tamah Yisrael of TMH Financial and Management Solutions. I'm going to give you a little more intro to the session in a moment, but first, we want to thank our FCI Live champion sponsors. We could not have made this series possible without them. Thank you to National Co-op Grocers, Dot Co-op, and Colluminate. All right, we're going to get started in just a second here with Tamah, and I just want to share I'm really excited about this session because not only do a lot of us who are starting food co-ops not have the kind of background to go, look, how should I be tracking this owner money that's coming in and setting up this? We get questions about it all the time. We don't necessarily have the background, but also a lot of us who have specialized knowledge in, let's say, data, finance, whatever it is, don't know exactly how to talk about it and connecting it to the exact needs of startup food co-ops. Tamaz got you. She has been there. She is a startup food cooperator. This is what she does. She works with startups, co-ops, and open and established food co-ops, as well as other kinds of co-ops with financial knowledge, helping them set up financial systems, helping them make work through their financial systems. So I'm so excited to welcome Tamah, and I'm going to turn the session over to her.
Thank you so much, JQ. I'm excited to be here. I'm really grateful to the sponsors and to the Food Co-op Initiative for having such amazing panels and conversations for our startup co-ops and all co-ops. And as JQ shared, this one is for startups. So if some of this stuff is like, I already know this, well, I am just sharing that this is for one-on-one accounting and just knowing what to do with your money. So if that said, that little bit out the way, I'm going to share screen and get us started. So this is, if my screen sharing eventually shows up, this is Financial Foundations for Food Co-ops. So we're really looking to talk to stage one co-ops here and giving organizers, people who are working to develop cooperatives in their community, food co-ops in their community, just some basis of how to manage things and how to keep track of things so that they're ready to go from fundraising, campaigning to groundbreaking on their project. So with that said, I'm going to move into the slide if it cooperates today. Cooperation is key. So why strong financial foundations matter? Just jumping right in with some just key points and necessities. It really ensures sustainability in throughout the whole process of developing your cooperative. So really setting up a financial foundation that can be transparent, easy to access, and for you and your team to really track from beginning to end is important. It's also a way that you can build trust with your members and funders. Uh, Having financial foundations also supports compliance, reporting requirements. And it really does prepare the co-op for long-term success. One moment, I'm going to chill out some background noise I have here. All righty, so thank you for that. Moving further into this, I just want to clarify what we're going to be talking about today. Is like, okay, Tamai, you're just laying the foundation of what we're doing. But what we will be talking about today is really understanding key accounting terms and principles. I want to say that I'm going to lean in heavy in this area because this is the area that I see people struggle with the most and not knowing in the starting of how to talk to funders, what information they need to be tracking, how they need to organize the data. These key terms and accounting principles is the source that helps you keep aligned and keeping your accounting systems managed well. We will also talk about effective record keeping practices, um, just getting some pointers in on that area, and also what do you need to be thinking about to be ready for a development project. And finally, we'll talk a little bit about how to keep track of your member equity or what you should be thinking about to keep track of member equity. So with that said, just really quickly, I mean, you can use the chat for this. What are some like challenges if you're a startup co-op, have with just even thinking about your cooperative finances? Are there fears, challenges, or just emotions? And I think I sat in a panel at Up and Coming, and this question was posed, and I thought it was really impactful. And the feedback that people gave at those brand new co-ops was powerful. So just using the chat, what are some fears, challenges, or energies that experience when you think about managing your financial and doing accounting? And we'll take a moment to let those things pop in the chat if they do show up.
Is everybody just wildly confident? Ah, concerns about capacity? Want to get it right from the beginning? Absolutely. And people are starring that one.
I know, right? It's
Just want to
important.
get it
Like,
right. Sustainability, figuring out what software to use, um, how to calculate cost of goods sold at the end of the month when no one retain. Wow, we're getting some detailed financial questions here. We're not so much the energy, but
yes, I like it. This is great. I love this crowd.
trying to avoid
But
government audits. Darn right. Let's not trigger one of those.
that whole conversation is just triggering all together at this point. So
Yeah.
that said, thank you all so much. And feel free to keep those coming in the chat as we go into really understanding some accounting key terms and principles. So here, I just want to offer and say that I won't nearly dive as deep as I can in this area, but I do want to give you a basic framework. And let's start with some stuff you might already know and some stuff you may not know and may not have connected the dots. And you're going to say, well, Tamah, duh, I knew that, but let's talk about it anyway. What is bookkeeping? This is one of these things that you might already know, but I'm going to say it. Bookkeeping involves the recording on a regular basis of your financial transactions. Plain and simple, right? Most people, this is a really common, very basic concept, but the one piece I want to lean in on is the on a regular basis. This is one of the biggest challenges that I see that a lot of, especially in your startup mode, addressing and tracking things on a regular basis from the beginning is like the primary thing you want to start thinking about. And the reality of it is, the moment you start accepting or doing any type of transactions, you need to be thinking about an accounting system, whether it's a piece of paper in a ledger, whether it's a actual spreadsheet or full on accounting software. A bookkeeping solution that helps you start from day one is really important to make sure you're not losing any important information. And really, this process is how you produce the financial statements. It's one of the small pieces, the beginning pieces to the entire accounting cycle. Now, I bring this in because a lot of people don't know that, well, I'm keeping these receipts, et cetera, et cetera. What happens with these things when I keep track of them? Well, they go through a process that accountants call the accounting cycle. And the accounting cycle simply refers to the culminating of all of your accounting records for further analysis, really letting your internal stakeholders know and make well-informed decisions, as well as relevant financial decisions. It also summarizes like events, uh, summarizes events in a particular sequence, such as a period of time, really becoming a quick guide for you to like do some analysis, decide whether further investments are needed. And if there's external stakeholders like a lender, they want to be able to see like how well the cooperative is doing. So this really involves four critical steps: collecting all transaction data from the beginning. So not waiting till you have a stack of things, but collecting things from the beginning, and then really identifying what those transactions are and how you want to classify them in your accounting system. Then it also means you need to analyze. So often what happens is we send all this stuff, maybe a shoebox, a bag, grocery bag, hopefully not, to your accountant. And you just send it to them, and they produce these beautiful reports with all these numbers on them. But what do you do with them in the aftermath? And so analyzing them on a regular basis is the work that you do to see how successful your business is. And really, as I said here in the last phase, is determine the performance of the cooperative. So this really keeps both your internal and external stakeholders, cooperative members, lenders, people who are invested in a cooperative, such as your community, connected to some relevant business decisions. All righty. And then further into this, I want to just lay out a few accounting terms. And if there's any questions that are coming up about this cycle that we have to take our data through, please let me know. But some critical points that you do want to be thinking about, which are some terms that you'll be tracking specifically, are your assets. So these are some like ground terms that we want to like think about on a regular basis with our financial. And to simply put it, your assets are resources owned by your co-op. This is the value of your co-op, part of the value that your cooperative has in creating and generating value for its members. So in essence, for grocery co-ops, the property, the store, all of the supplies that it has is how we generate value for our members. And so these assets play a critical part in that. The other piece that we want to talk about are liabilities. Liabilities are just at its basic idea, your debts and obligations. Uh, Liabilities can look like payroll. So if you have people on staff, once they work and you haven't paid them yet, that labor, that output becomes a liability that we owe that staff member for their work that they outputted. Things such as if you buy, you purchase on time, meaning that you purchase items and you have to pay it in a different period, that is also a liability. But the number one liability that we're familiar with is our loan debts, even from members as well as bank loans. So all of these key pieces, these two pieces get situated in a particular report, and we'll go into it in a moment. But these two make up one part of the accounting equation. And then, of course, this other basic principle that we want to talk about is equity. Equity is the ownership value in the cooperative. So members actually create the value of the cooperative through their equity investments. And we'll dig a little deeper into this in a moment. But these key terms will help us build the container for your financial data. So just thinking about these three that we just mentioned, they are the first three that go on one of the critical financial reports that we'll use to analyze our data. And then the last two pieces are your revenues. Now, most of us are very familiar with revenues. If you sell something, you make money. So that is your income. And this is the income from your operations. And then simply put, your expenses are things that you purchase in order to keep your cooperative in operations. So, like I said, this is some stuff you probably already know, but we want to name it and give it the terminology that is used in different accounting spaces that allows you to communicate effectively with lenders, with people who might be other stakeholders, and also help you analyze the success of your cooperative. Now, what do we do with these things once we get them all collected? Let's move into the reports here. Oh, well, before we move into the reports, I do want to name one other piece of information, and I apologize for skipping ahead. But when we do accounting, accounting can happen in a couple of ways. And some principles in accounting refers to how we track revenues and expenses. And cash basis is a method of tracking revenues and expenses when your money is actually received in your hands and when transactions are actually paid for. So it's basically the moment the money hits your hand, you are recording that money. The moment you spend it, you're recording that. And if you're a small business, most small businesses use cash base of tracking and recording their data. So corporations with an average annual sales more than 25 million just technically are not allowed to use cash basis because of so many other factors. The other method that's really a method that keeps us compliant with federal policies, the IRS, is accrual basis. And larger co-ops, and I'll just say this, grocery co-ops in general use accrual basis. And this is a method where your revenues are recognized when they're earned. So you might not have received the money, but you recognize the revenue because you've earned that revenue. Whereas expenses are also recognized when they're incurred. So we mentioned earlier that a liability could look like if you have to pay a vendor, you purchase those goods from them, you receive those goods ahead of time. But what then happen in the aftermath is you may wait 10, 15, maybe even 30 days later to pay that vendor for those goods that you receive.
Mhm.
These two processes really helps you understand how accrual works. And so accrual basically means that you're going to track it when it actually happens, even though monies actually haven't actually been exchanged. And so accrual is really consistent with the generally accepted accounting principles. And this is highly recommended over cash basis. And to just the name cash basis, if you are paying vendors on time, you are technically using accrual method. So you might have a mixture of cash and accrual, and I've seen that in a lot of small businesses, but that's technically not proper accounting. So you do want to select one or two of those, one of those methods so that you're predominantly in compliance with federal regulations like the IRS. Or even if you have to do an audit, accrual helps you be compliant with those terms. And so it really is going to differ based on the size of the cooperative, essentially. Smaller, like we mentioned, will use this. And if your grocery co-op, it's highly unlikely that you'll use a cash-based method. So this is something you'll see a lot with your smaller service-based cooperatives versus grocery cooperatives. And really, the other piece I want to lift out is that the complexity of the transactions. Accrual basis is really meaningful when you have a lot of complex transactions. And we know, those of us who have been in the grocery sector, it is a most complex process. But if you're here, you're probably brand new. We want to let you know that you do want to use accrual basis and that operating grocery cooperatives financials are very complex transactions to manage. So not to institute fear, but to just name that looking at this with a critical eye right now is an important step. So I'm glad that you're here. So we've gotten those little things that you might already know out the way, those things that you might not have heard of out of the way. Let's talk about a few more things about accrual so that you can also be in compliance. So, one of the key things we talked about was purchasing goods, but really a benefit for accrual actually helps you keep your inventory purchases accounted for before they're sold. So, what does it look like to buy these items if you are on cash basis? You have your shelf stock, but it's not actually adding any value to your business by sitting on a shelf until that item is sold. Accrual basis affords you to add a certain amount of value for all of your products and services, your products that are on your shelves or before you get them on shelves, to be accounted for in your financial reports. So they are also valuable in when a lender or a funder is looking at your business, inventory, and other assets like equipment, help you make sure that you're showing the true value, the investment that the cooperative has. So just wanting to lean in on that because I've seen a few places in smaller businesses where inventory is like accounted for in a very haphazard way. And one of the critical things about your business as you go into it as startup cooperatives is that your inventory is the number one asset that you want to keep track of. And this accrual basis helps you create that value for that in your accounting system. All right. So, what are these elusive financial statements and why do we even need them? So all of those things that I just talked about a few moments ago, your assets, your liabilities, your member equity, your revenues, expenses, and even how you're tracking it, whether it's cash basis or accrual basis, they all compile into these beautiful documents that look like some different foreign ancient language that is really difficult to interpret. Yeah, I know because I actually produce these things and clients ask me all the time, what does this actually mean and what are you telling me? So we won't do too much of a deep dive in translating your financial statements today. That might be a different workshop, but to get you to the point where you actually know and have this data organized in a way so that you can translate them. Let's talk about what these financial statements are. They essentially provide a snapshot of what your cooperative's financial health. It really gives you and others insight on performance. It's one of the only ways that you look to see how well you're doing. It also gives an indicator of operations and cash flows. And they're very essential because they really talk about like what we just said a few minutes ago, your revenue, expenses, profitability, and the debt. So who do we owe and who we need to pay? So a trio of financial statements that are commonly looked at. And as you can see here, we have the balance sheet, the income statement, and the cash flow statement. There are other financial statements and there are other financial data points that you might want to look at in your operation once it gets to open. But for startups, these three basic are really key for you to understand how they're structured and what to do with them. So we'll talk a little bit about that. And again, I'm queuing us up for a more intense workshop in the future. So let's look at the balance sheet. We will be looking at a physical balance sheet today, but I want to talk to you about what a balance sheet is. The balance sheet is one of the financial statements that really talks about all of your assets, your liabilities, and your equity. And because of the name of the balance sheet, it abides by an equation. So assets essentially should equal your liabilities plus equity. And you're like scratching your head, like liabilities plus equity. So liabilities naturally decrease certain things because they take away versus assets, are positive. So the equity plus the liabilities creates a value. The assets have a value. And if those two don't balance out, there is something wrong in the equation. So essentially, the balance sheet is supposed to have the numbers equaling the same thing under the assets column and the liabilities plus equity column. And they're not necessarily in two separate columns, but they're lined up in a structure. And we spoke a little bit about what liabilities are, but let's talk a little bit more. Your common liabilities includes accounts payables, payroll, and loans. There might be some other liabilities. I'm curious if any tenured cooperative organizers are in the space. Maybe you can name some of those in the chat. If not, we can continue. But I would love to hear if someone may can lift out what another liability might be. With oh, look at that! I see that. Is there any? I thought there was a note in the chat. There was not. That was someone's AI. But that's it. If there's an additional liability that someone can name, I'm thinking of one in particular, but I'm hoping someone picks up on this and put it in the chat in a moment. No, okay, no takers here. All right. So, but funny thing is insurance. Okay, that is not quite alive. It's an AP. So your insurance bill is something you have to pay, which is a great guess. It is a part of something you must have. It actually you can accrue insurance because you actually are in investing insurance. So that's a little bit of a different thing. I think the thing I was looking for was gift certificates. A lot of times people don't know that when you sell gift certificates, those things generate a liability so that you actually have to pay out that monies to people in the future. Yeah. So, and some people treat them differently, but in a lot of cases, gift cards are indeed a liability. And there's some other types of liabilities that we can name, but the main ones we've already lifted out. Your payables, your loans, and other things like payroll. Another one that's really critical that I think that we might not be thinking about is sales taxes. Oftentimes, sales taxes may or may not be on the forefront of your mind, but when you collect sales taxes for any municipality, that generates a liability for your co-op. So giving you those couple of little pointers because one of those things that you want to think about when you're setting up is how are you going to be tracking sales taxes? And most POS point of sale systems support you in doing that tracking. So there's a little nugget there. You want a good point of sale system that helps you with all of this mismatch that you're going to be dealing with eventually with your co-op. All right, let's move on to the next financial report. Now, this one becomes a little elusive because we generally talk about and deal with the balance sheet and the income statement. But most of the time, we are not looking at the statement of cash flows. And I will say this, some lenders, I think there are a couple of lenders in the conversation today, can speak to this. They do want to know if your cash flows are solid cash flows. And the statement of cash flows actually gives that critical information. It looks at whether or not you're generating enough cash to pay your bills. A lender won't lend to you if you aren't really generating that amount of capital to pay your bills, or they may have a little hesitancy. Business model may be sound, but they may be more hesitant to actually lend if you aren't quite in that space or can't prove or have evidence that you're going to be able to generate enough capital. Another thing that the statement of cash flows does is it's going to show the total cash flow coming in or out. So it's going to adjust your income to net. So it's reducing a few things from your total income. So it looks at what it should, a net amount that is tied to your income statement. And really, the cash flow statement is going to use to look at the quality of your earnings. So what it is going to look at is going to look at cash generated from your core business activities. At the very beginning of your organizing, your business activity may be just capital fundraising and member campaigns. You're generating cash from creating a member campaign. And that's why they recommend, and FCI has recommended these different stages. And in certain stages, your member campaign is looking like a certain thing. So you have to have a certain number of members in these various phases. This is letting the people who might be investing in your cooperative know that your community is invested enough in your cooperative. So at the very beginning, your cash is going to be generated from these campaigns, and this is actually telling us whether or not people are invested in the cooperative. It also looks at cash generated from debt or selling off assets. And in the very beginning phase, you might not have these activities going into the cooperative, but you do want to ask eventually, once you get open, why did your cash flow change? And it will change once the cooperative is open. Um, a lot will change once the cooperative is open. It would also look at cash received against accrued net income. And this gets into the weeds a little bit. So I'm going to not dig too much on this report because this is more of a deep dive subject, but a statement of cash flows really gives you a good picture of if the cooperative is steady, it has enough investment, and whether or not you're like overflowing in debt and if you're having to sell off things like your assets. So just naming that the statement of cash flows is also very important to look at. Maybe not as much in the beginning, but as you go throughout your business, it becomes more and more important. The third piece, which is once you're really generating income, will be very powerful, your income statement. And so your income statement tells us two specific things, right? It's looking at how much money you're bringing in and how much money you're spending. In the early stages of your cooperative, most of your money coming in actually won't even sit on your income statement because you are generating money from member equity. And we'll talk a little bit more about this. So your income statement in the beginning phases won't look that pretty. You're probably going to have a loss reflected because you might be spending money on some of the initial things that you need to spend on, like software for tracking your member equity investments. You might spend money on even marketing and things to that effect. But just being mindful that at the very beginning, the income statement will have a different look. But once you get open and you're generating money from selling merchandise, your income statement can and will look different over time. And we say over time loosely because profitability in a cooperative model at the beginning phases is one of those things that we eventually get to, but patient because the cooperative is here to serve and benefit its members. So I'll pause there if there are any things that are surfacing because I know I said a lot about the uh, statement of cash flows and the income statement, and also knowing that the income statement will look very different at the beginning of your cooperative endeavors. All right.
We have questions coming up. So it's interesting. We have some questions that are about, basic like setting up of systems in the very beginning. And then we've got questions that are much more in depth, like calculating cost of goods sold at the end of the month when the inventory is taken. So
Okay. we're we're gonna pause on the cost of goods sold because we're
yep.
not there yet. But I heard something about in the beginning, right?
Mm-hmm. Well, long before you have a store, setting up systems.
Yes. Okay, so we're going to talk about that. Let's get to that here. And that's in the presentation. So now that we know what kind of documents your systems will address and will track and generate for you, and the data, how it ties together, let's talk about some best practices here. I have these records here because people think when we say record keeping, we're not talking about your dad's album collection or your best friend's 45s, which I'm old enough to say 45s. Some of us might not be that old. uh, but we're talking about all of this stuff we just spoke about, every transaction that leads up to your balance sheet, your income statement, your statement of cash flows. You definitely want to set up a system in the beginning. And we spoke about this earlier. Uh, I said a piece of paper, but I highly recommend starting with some kind of digital system that tracks member equity in the beginning, because the very first thing that you're going to be tracking in the beginning is equity. Members will be making investments. You might be actually paying things on behalf of the cooperative. And how are you tracking what you're spending? You're personally spending out of your own pockets, or and I'm hoping you're not spending too much out of your pockets. You're generating member equity to actually make those purchases or those initial things that you need. But I recommend QuickBooks or another tool similar to QuickBooks. You can use QuickBooks Desktop or QuickBooks Online, and most people are using QuickBooks Online. These tools can create a very simple way to track your capital and track your reports in the beginning. But I know FCI has some recommended member equity database systems that they probably will say, hey, use this because we've seen cooperatives have success in this. And I see a lot of things coming in on the chat. So if there's anything pertinent, JQ, please let me know.
I will let you know. And I
Oh,
will
I
say
see
that
some
our
recommendations.
recommendations aren't any different. QuickBooks, please. It's intuitive. It's easy. It can ramp up later if you're not. So we just suggest that. People have a lot of questions, I think, that point out that there's a difference between accounting software and point of sale systems and tracking sales. I think that's where the conversation is there's some confusion around that.
Got you. Okay. Well, I haven't gotten to sales yet because I'm speaking to people who aren't making sales right now. Uh, so just to be clear and transparent, uh, once you do get sales, though, it is really good to have a point of sale system that can integrate into your accounting software. And I don't have the names of all of those, but ECRS, of course, Food Co-op Initiative can name some that integrates. But QuickBooks allows for a number of software, point of sale softwares to actually be integrated into it. So that's why a lot of people recommend QuickBooks, because the point of sales, just for those who are new to this, it's the system that actually is tracking what products you're selling. And the point of sale system in a grocery co-op is very detailed because it is tracking from the product PLUs, which is a coding system for your products, even to the degree of like the quantity of those products that you're bringing into your store. It depends on the point of sale system that you have. But the point of sale system helps you bring in those products and then helps you track how many of those things you're selling. Now, it doesn't pull that data into a comprehensive financial report like an income statement or a balance sheet. It provides the sales data that is needed for you to develop the actual income statement or balance sheet or cash flow statement. So, two different tools, both very, very critical, right? So the point of sale not as relevant in the beginning phases because you're not selling merchandise that we know of per se. And if you are selling merch, it might be like t-shirts and swag, etc. And a lighter point of sale system would be sufficient for those things like Square or another tool similar like Stripe. But stick to one. I'll say that because I've seen startup grocery co-ops have maybe two, three of those different things. And once you get open, you're going to have to pull all that data into one system that helps you generate that historical profit and loss statement or that historical balance sheet. And trying to pull two or three different lighter POS tools like Square or Stripe into a new your accounting can be a nightmare. So I would recommend if you are a startup co-op and you're looking at selling member equity, etc., and a shape or square is something that you're looking at, choose one. That is just, wisdom from the start because you will have a nightmare in trying to pull and consolidate that data in the aftermath.
That's people are thanking you in the chat. People that really did help people. I think to get back to focusing. I just want you to know we have about 10 minutes at this point.
Oh, perfect. Okay, so let's get into these best practices because I lean very heavily on the terminology. But things you do want to track: member equity contributions, all receipts and invoices. If you even have people that are working for you in the beginning phases, like contractors, we're saying payroll records, but ideally you're probably not having payroll right now, but these are things that you want to keep track of. The benefits of digital information is enormous. It makes it very easy for a person like myself who lives in a different state from you to actually help you track things. So something like Google Drive and or QuickBooks. QuickBooks does have an interface to actually track and keep track of your physical documentations. So back those things up into a system like one of those things. And do have periodic financial reviews. You want to look at your financial statements on a monthly basis. And eventually, once you get to the point of being open, you do want to have internal audits and internal reviews. I did not get to the half of this presentation, but I talked about some basic terminology. And I want to maybe lift up one more point and then we'll get to a stop. Some things you want to think about in getting ready to get a loan, get to groundbreaking, right? Your financial records is one of the critical things that a lender is going to look for. So if you have not kept track of these things in the beginning, you will find yourself trying with your shoebox of receipts to track all of this stuff and put it into a financial statement for a lender. You want to be able to use this to help you create some budgets and projections. And we say hire professionals to help you get to the budgeting and projections. There is a whole science to this, the feasibility process, and Food Co-op Initiative has a whole toolkit on feasibility. So use that to get to your budgeting and projections. Startup costs. You probably paid some money out of your pocket for some stuff. You probably had people in community donate some stuff. All of that stuff had value. But as you're moving into groundbreaking, you do want to keep track of what it's going to cost for your inventory, rent, equipment, etc. And then tracking everything like your grants, loans, and any fundraising income is going to be really critical. And finally, you do want to make sure that you are, again, lifting out those audits because a lender and getting to groundbreaking, they want to know that the integrity of that data makes sense and that it's meaningful to what you're moving to do with the store being open. So again, I didn't get to the half of this. Maybe there's a part two to this, JQ, but I will stop here for all of the questions that are surfacing in the chat.
Okay, so first off, it's been interesting the breadth of questions in the chat, and some of them, I'm just going to point out that some of them were like member databases. If we after this session, when we're done recording, when we're done focusing on finance, if you linger afterwards, happy to answer questions that aren't connected to what Tamah's presenting at. So I am here. Just stick around for a few minutes. But if I see stuff that's not related, not closely related to what Tamah's covering, I'm not ignoring you. I'm saying I'll talk. I'm happy to talk to you right after the session if you'd like. Um, so what are the questions? There's like a lot of questions about financial systems, um, sustainability tracking, and I think I do want to bring this up. that I know you didn't get a chance to get to it. I know it was in your presentation, but there were questions kind of throughout that felt kind of laced through like tracking member equity. And there's one thing about owner database as in like who your owners are, but tracking equity. Can you talk about that for like the really early startups who maybe are just barely fired up their QuickBooks, how they should be thinking about that?
Absolutely. And let me just pull up this slide. So in tracking member equity, first and foremost, understanding what equity is important, right? So equity is the actual investment in members make into their cooperative and becoming an owner. And so they members essentially have a responsibility in investing that. The one thing I want to talk to though is that sometimes we have buy-ins that are like uh $20 and it might be 100. Your total might be 100, so you give people that opportunity to pay it off. The way we track that is one of it actually the first partial payment becomes an actual buy-in, but the remainder of it is a receivable. Though it is cash, right? You're saying on your financial statement that this money hasn't been received yet. It will be received in the future. We are expecting this, but this portion of it has been received, and this part of it is on your balance sheet. And it's part of that balance sheet formula that actually gives the equation of assets equal liabilities plus equity. So tracking that on your balance sheet is important. But I want to also name that having a separate tool like a spreadsheet or a database to reconcile your balance sheet is important because oftentimes you have members that at the very beginning they may want to be a member but they may never shop in the store again, and that equity is still sitting on your books. So you do want to do a regular audit of your member equity and just determine how much of that actually becomes something besides. There's a weird noise in the property that I'm in, so I apologize. It becomes not an actual legitimate equity that members are continuing to be invested in a cooperative. So I just want to stop there because that opens up a can of worms that we're not prepared to go into today. But do know that there are different ways for members to buy into their cooperative, and how you track that on your balance sheet is going to be important for your financial statements.
Thank you. I just wanted to bring it up because if there's one thing I could say to startups that I didn't get it at First Social Co-ops either, owner investment is equity, not income. It's equity, not income. And those are two
Thank
different
you.
things.
Thank you for saying that. Thank you for saying that. I did say balance sheet, but I didn't specifically say do not record that as income on your profit and loss statement. And that is a number one mistake I've seen as well. Uh, but I did say balance sheet, just didn't specifically say
No,
that.
you
So
did,
thank you for
absolutely. I just know a lot of GMs have gotten in their startups and gone like, what is all this income? They're like, that's not income. That's your owner. Oh my God. And so we may not be able to solve for you today, like if you didn't understand what we just said, but it belongs on your balance sheet. You can reach out to Tamah for further support or other whoever you work with on finance. But it's one of the most common mistakes I see too, and I figured you had as well. Other questions, comments in the chat about getting started with finance as a startup? Okay, there's questions about tracking member share of earnings, but again, I feel like these are open questions, it's over open store questions. Um, so like if you had basically if you had profit, if you were operating a store and you had profits, and there was a and the board decided to vote to pay some of that as owner dividends, how you would track those earnings. And I'd have to say that's a whole other session that we need for
that's
open co-ops.
patronage.
Yeah, patronage is a
Yeah.
whole session. All right. Any other questions related to beginning finance? Oh, let's see. Our membership fees. Oh, okay. So if you have and I was going to ask this, but I didn't go there. If you're charging a membership fee, like an annual fee, in addition to like the stock purchase, in other words, the equity to be an owner, are those the same thing? Are they both, is that annual fee income or equity?
So I guess my first question would be is how is your cooperative organized in and does it allow for additional buy-in into the stock throughout the year? And if so, then it would be added to the capital accounts. But if not, it's a program and your bylaws don't allow for additional membership fees. So it's really the entity type and what's stated in your governing documents that's going to dictate that, right? And some states have statutes that have ways that that's tracked, and each state has different laws. But essentially, if your bylaws are structured where you can have additional buy-ins, which I'm not as familiar with cooperatives that do that as much,
It's rare,
but
but it still exists. Yeah.
yeah, it does exist, right? In general, additional fees are treated as some sort of income program. But if it's a buy-in, it increases their capital account, which is also another large conversation.
Yeah. So if it's a fee, income. If so, but we won't go too much further than that. Someone did ask, and this is a good question. Again, because you're new to this as startups, you're hearing us throw on a lot of financial terms. What is the difference between our sources and uses for our project and a revenue and expenses report?
Oh, I love this question. So
Yeah.
your sources and uses are really referring to what it takes to generate enough revenue, or not revenue, capital to open your cooperative. And it's going to really be referring to your startup phase, whereas revenues and expenses are in operation. So as you're developing your cooperative or any capital campaign, so say for instance, the cooperative is open and you decide to add on an addition to the property, you're going to generate a sources and uses for that development project. And it's really to name how you're using capital that you're raising, whether it's through member capital, through loans, etc., to pursue this development endeavor or this capital endeavor. So sourcing uses are mostly in startup, but also can be aligned with any additions or special projects that the cooperative may get into. But revenues and expenses are specific to the why your cooperative is open, the sales of products and services, and the general operation of the business. And I see do I have a recommended chart of accounts list for startup? Uh, well, I know that NCG, National Cooperative Groceries, is working on some tools and resources for existing cooperatives. They may have moved into a phase where they have a recommended list for uh, chart of accounts list for startups, brand new. I will have to look into that. And JQ, you might have a deeper connection to find out more if they do have a recommended chart of accounts. But I know that NCG is working on some stuff.
Yeah, they are, and I think we've gone around the circle before. There's something called, yeah, there's a what's called. You'll hear there might have new terms for it now. I've been out of the game for a while, but called Cocoa Fist Chart of Accounts, which is shared financials that food co-ops use,
Mhm.
and they do recommend that startups use it, and you won't be using a bunch of a bunch of the accounts, but you'll be using, but you'll still be set up. And I thought we had a copy of it. I will double check that with it being granted to us, like so you'd have the standard chart of accounts. So let me check if I can find it. Let me see if I have a current copy that we're allowed to share. If I do, I will email it out to everyone who attended. Um, yeah, so there's folks in the chat who are saying, yeah, see Jen who's in the chat is a finance manager for a food co-op. So the common chart of accounts that is used by food co-ops. If she chooses to share that with you,
Mhm.
that's between you, her, and the wall. But I think I have a version that we're allowed to share. I will double check. It's one of those things that we've had at times, and I don't know how they have one that's recent. So, but it's best to get set
Yeah,
up
I think
doing it.
right. I was getting ready to say I don't know that those chart of accounts are being shared widely yet, but I know that they are in the process of developing something that is meaningful for food co-ops. And they are rolling out a common chart of accounts process, have been rolling out a common chart of accounts process.
Yeah. And that's one of those things if you have a again, I'm not trying to put anybody in a bad position, but also it's if we're talking about just like the types of accounts, if you have a mentor co-op, you might reach out to them and see if it's something they're allowed to share with you. But right now, and we have been, it has been shared in the past. I just think the one I have is kind of out of date. And I don't mind NCGs. I mean, I don't mean National Cook Grocers,
Mhm.
but they are related. So I'll see if I can find one and share it over with you guys because it would truly be useful. I'm gonna go ahead. Yeah, I believe me, it's one of the awesomest things that we all cooperation among co-ops. We share financial data with each other, so we share a general kind of chart of accounts. I'm gonna wrap us up. Those who want to stay after and ask a few extra questions, you're welcome. But I want to take this moment to actually properly thank Tamah for being here and sharing her wisdom and experience with us. Thank you so much. And for those of you who are here, if you can take that survey we just emailed out to you, it's a 2-minute survey. It takes a very short amount of time. The feedback really helps us make these sessions better. It's completely anonymous. We'll share it with Tamah. We'll look at it ourselves and see, was this useful to you? What would have made it even more useful? Would you like things more like this in the future so we can keep making this series better? We really, really appreciate it. We've got one session left in FCI Live 2025 tonight, Reimagining Co-op Funding with Katie Novak of Katie Novak Cooperative Coaching, talking about some of the unique ways as funding our startup food co-ops, and the way we do that is starting to shift. Some of the unique ways that startup food co-ops have successfully found for small and large amounts of money to bring in funding that is unique and wasn't being done just 5 years ago, maybe even 3 years ago. So it'll be a really interesting session. Hope you'll join us. And one more time, we had a record number of sponsors this year. We are so grateful to all of you for sponsoring FCI Live 2025. Every single organization on here believes in the startup food co-op movement and is doing something every day to help it, support it in different ways, and we really appreciate them. Thanks so much to them.